Hello Trade Pros. In our last survey in the community, we asked you what you wanted to learn more about, and you said trading strategies. In today's video, I'm bringing you a trading strategy that we utilize every single day in our live trading room for stellar results. This involves trading the US market at 9:30 in the morning on the open, and it can be applied to any futures market, including the Dow, the S&P 500, the E-minis, oil, and many others. Enjoy the video. Every morning at 9:30 a.m. Eastern Time, the US equity markets open. And when these US equity markets open, you tend to see a lot of early volatility around this time frame because you have the traders who held from overnight. These are the traders who participated in the London Open session and the Asian session, whose actual day ends at 11:30 a.m. Eastern Time, because then it's 4 p.m. and onward in London, UK, and other European markets. So when you start trading at 9:30 in the morning, you're going to get a lot of volatility. This is your prime window. This is the maximum opportunity that you're going to get for the entire session. So that's why this strategy is very useful, particularly in the first 1 hour after the United States trading session opens. You want to start this at 9:30 in the morning, and you want to be paying attention to the news and any events leading up to the 9:30 open and what's occurred overnight, so you're prepared and ready to tackle the market with this strategy. Now, before we jump in and I show you the strategy on a live chart, I want to take a moment to explain it to you here on a white screen so you can understand what we're actually looking to trade and what events and sequences we're looking for to happen before we jump in. All right, so let's assume that at the 9:30 open, you're seeing price action right here, and this vertical line represents the 9:30 session open. Immediately, the first 1 to 3 minutes to 5 minutes of the US open up to about 9:35, you'll see a lot of volatility and a lot of sideways price action. I tend to want to skip out on the first 5 minutes. I do not trade those couple of minutes unless there's extraordinary circumstances and there's a good opportunity. But what I'm waiting for is to see a little bit of movement in one direction. I'll draw a resistance at the top and I'll draw a support at the bottom of the 5-minute range, and I'll identify where do we go from here, as well as looking at the open price of the session. The idea here is to be able to actually catch the pullback to the open and not the initial move. Many traders are interested in catching the initial burst of volatility, but that's the one that's the hardest and comes with the most fake out opportunities that you're waiting for. The reason being is any one of these breakouts you're looking for could actually end up being chop in the first 3, 4, 5 minutes, as we discussed. So what you want to see here is price action break the 5-minute resistance and or the 5-minute support if it's a downtrend, and you're looking to buy the pullback into this open price or 5-minute support, or former resistance now converted to support, for an opportunity for the continuation wave. You're not looking for the impulse wave as a trader, you're looking for the high probability continuation. And the reason it's high probability is because early traders who jumped in on the breakout are now getting stopped out, and traders who missed the opportunity to get in are going to look for that same level to start buying. Those continuation traders are mostly your professional traders, and this is the crowd who's got a lot of money: institutional traders, portfolio managers, pension fund managers, and the likes. And the initial wave here are the breakout trader, who happens to be the retail crowd. All right, that's what you need to understand. This is the opportunity that we're looking for. Now let's jump in on a live chart and set up a few of these trades and put this into practice. All right, what we're looking at here is a chart of the NASDAQ futures, symbol NQ. This strategy is applicable to any futures market that opens around the 9:30 time slot. That's the Dow Jones contract, the YM, NASDAQ, the NQ, and most popular and famously the S&P 500 contract, the ES. So what we have here is an example of today's open at 62.46. That was the opening price, and you see the initial drive happens to be lower. Now, as we discussed previously, we're not looking to short into the initial drive. We are actually looking to catch the retrace. However, none of these strategies or any strategy that you learn is not a standalone tool. What you need to do is apply it with other metrics that you have, other qualifiers, other analytical frameworks to help you find the highest opportunity trade. It's not a standalone, here's the price, here's the entry, and this is what you could do and not look at anything else. You need to qualify the good trades, and just like any other strategy, there's bad and losing trades, and there's also good and winning trades. Through being able to use a wide array of tools, you're able to remove the bad opportunities and only take the good ones, and that's what we focus on and teach in TRADEPRO Academy through the usage of order flow tools and analytics, also using correlations, volume profiles, and many other tools that combine together to give you one opportunity. But in the simplistic example, what we want to notice here, and one of the reasons that we didn't take the short, look at this, when price rallied back up to the open, this is where the trade would qualify. You have the initial push lower, and then you have the retracement, and normally you would want to see a continuation phase to the downside. However, the one disqualifier we had in our trade, and a lot of traders will have qualifying criteria, I also have disqualifying criteria. What disqualified the short opportunity for me on the open is to actually look at the volume on the drop and notice that it was very low and weak. When you're seeing a sell-off on weak volume, that's actually a bullish or upside tool. It tells you sellers weren't strong. This could be a little bit of a sell stop run, but the next wave up, if we do get volume, it starts to look more interesting to the upside. So what we did is we sat patiently at 931. You can see this is the initial 1 minute that passed on this chart. This has been only 1 minute by this point. So we were watching and we noticed that on the open, and we saw it break north of the open price at 46. The one thing we noticed at this time around 931 is on this drive higher, the difference was that volume was also increasing at the bottom of the chart. All right, and with that volume increase, we had our opportunity to start looking for a long trade. We had the open, an early sell-off on weak volume, the rally, and then the break above the open price came with some high volume. So now we're triggering this trade idea of getting long the open based on price action so far. Any pullbacks to 46 would generate a good buying opportunity. So we're watching and we see the price hit there and it's oscillating and it just about touched it. And why does it do that? When the open price is bought, institutional traders who have large money to trade can't get in on this initial burst, so what they're forced to do is place their buy limit orders down near the open, so as the sell-off comes, they pick up that liquidity and take it higher. This is the low risk, high opportunity of the day with this strategy. It's the break of the open and the retest and continuation and roll forward. And in this example, if it would have held the open and volume was strong on the downside, you would want to sell here for the bearish continuation and not the bullish or the BULLC, the bull continuation. And you could say, well, George, that's awfully easy for you to say that now that the price has already happened. And I'm going to show you today's actual trade orders that were filled. I got a chance to get long as the dip was happening into here. My stop was below the open. So when you're buying a retrace to the open, you want to put your stop loss below that open price. And these sells here, I had a 4 contract long position, and as it took a long time for it to break out, I was getting rid of my long or unloading the position at break even. I am a day trader. I scratch trades a lot, which means I get into them and get out of them at no profit or no loss. And that allows me to continue trading and stay in the best opportunities. However, I did leave one lot on, and as it exploded higher, you will see me eventually cover it. Literally on the high tick. This doesn't happen often, but just a few minutes later, we caught about a 12-point move on the NASDAQ. That's about $260 per single contract, and that literally happened from 9:31 to about 9:35 in the first 5 minutes of trade. So if all you're looking for is $260, that was your workday right there in 5 minutes, and you could move on and do something else. That's the beauty of this strategy. All right, so I challenge you guys to look at this. Every single market that you're trading at, draw a line on your chart that says this is the open. Find out in the first 1 to 3 minutes which way is the sentiment moving. Find out which way the volume is supporting and look to buy the break and retest of that open for the upside. Stop looking for these initial moves and start looking for the dip and continuation on either frame of this trade. All right, it's important to know that the retrace and continuation may have been bearish today, but the fact the volume was weak, disqualified our trade, and kept us on the right side of the market. Another tip I'm going to throw in here as a bonus, this trade tends to work really well when it's in the direction of the overarching trend. We've had a really strong bullish market the last couple months, last couple years in fact, and if you're aligning your buying opportunity or your trade opportunity in the same direction as the trend, you're turning your sails into the gusting wind to help you propel forward. It's very important to treat trading like sailing. Always turn your sail into the wind and capture that momentum because it will push you forward. All right, trade pros, and there you have it. I hope you enjoyed this video. Please like, share, comment, and subscribe to our YouTube channel for more great content, and I'd love to hear from you. Have you tried this strategy? Do you plan to implement it? And what kind of results you hope it would generate for you? I look forward to see you in our live trading room to see this strategy in action and more. Have yourselves a great day, and until the next video, trade like a trade pro and manage your risk. Take care and goodbye.